Hello, my name is Mike Florin, and I'm the owner of Low Cost Mortgage. Today's your weekly update for November 8th, 2024. All right, well, the election happened earlier this week, and markets took it really well. I'm going to go ahead and pop open a chart here over to my right, and I want you to see what happened over the last few weeks in preparation of what we're going to talk about, what might happen this year. Rates went up. The Fed decreased the rate a month or so ago, and then rates started to go up, and they went up pretty substantially. There was a lot of bad data that came out. Jobs were coming in high, but then being revised low. It's basically a lot of turmoil. The financial industry, especially mortgage-backed securities, when they see turmoil, they get risk. They're very risk averse. Rates go up, basically. With that being said, a jobs report came out right before the election. It showed 12,000 jobs, when it was anticipated that it would be well over 100,000 jobs created. That's pretty heavy downward pressure. Now, out of those 12,000 created, 40,000 were government jobs, which means the private sector actually lost quite a few jobs. 28,000 jobs or so total. Or they lost more than that, but overall as a bit of the whole. But with that being said, now you have an election. Election is passed. So now let's look at the future. Look at this chart that's 1 year of 10-year Treasury. And the reason we're looking at 10-year Treasury instead of taking an MBS chart and flipping it upside down is really simple. The Treasury is going to show generalistic trends, and it's really close to MBS's up and down. It's not exact, but it's pretty close. But more importantly, it shows pressure, one of the biggest pressure indicators that we can see, and easily monitors the 10-year Treasury. So for you as realtors, if you want to know roughly what rates are doing, just on your computer, save a tab that shows 10-year Treasury on it, a live update. And then all you got to do is monitor 5 months, 6 months, maybe 3 months worth, and just look at it, see generalistically, is it moving up or moving down? Okay. So this 10-year Treasury chart, we are looking at 1 year right now. And that 1 year shows a heavy downward trend in rates last year at this time. Why is that? Well, every November, December is typically a really downward trend in rates. In fact, if we open it up and we look at our video last year, at the end of October, I came out on video and said, hey, look, every year for the most part, it goes down November, December, expect rates to go down. What happened? Rates went down. So what does that mean for realtors and real estate selling and whatnot? Well, it means that the hype from 2 Fed meetings ago, there was one yesterday where they reduced the rate again, but from 2 Fed meetings ago, the rate was, or the hype was, the Fed reduced their rate, therefore rates are coming down, everyone goes shopping, and mortgage rates took off. Well, now the Fed decreases their rate, they're kind of close to the top of what people anticipate the top to be. There should be a downward pressure or downward trend in rates, which means now what people are seeing in the media and the news networks in a few weeks or so should match what they're thinking or their expectations are. That should bring an upflux in buyers. Now, right now, it's a buyer's market, very similar to the middle 2000s, 2004, 2005 timeframe. It was really heavy a buyer's market, and it's been that way now for a few years, year and a half, 2 years, depending on where you're at. So what happens when it's a buyer's market and you start to add more buyers to that, now you have an oversaturation of buyers, and it starts to possibly balance itself out or become more of a seller's market. It just kind of depends. Now, rates themselves, if you notice from 2 weeks ago to now, look at this chart again. I'm going to draw on it, and it's going to show that it went up, and it's kind of flattened out a little bit, and it's starting to head down. It's starting to be green. And we're seeing that daily on what we're seeing on rates and pressures and everything else. In fact, 2 days ago, interest rates got better by most investors 3 times in 1 day. It actually repriced better, which is good. But at the same time, repricing better through the day doesn't mean, extremely low rates or whatnot for everybody else, or, a big downward pressure, downward trend. But let's look at rates for a second. We're matching roughly where we were 2 weeks ago. Conventional, middle 6s to low 6s, depending on if you're using Home Ready Home Possible, first-time home buyer, or regular conventional. And that's, without buying down the rate or anything. So you're somewhere in the 6s or so. And in government, VA, FHA, you're somewhere in the 5s still, again. So in all reality, is it bad? Is it up in the 7s or even 8s like some lenders were last year or even part of this year? No, it's not. But is it down into the 4s? No, it's not. Now, where were rates before the pandemic? I brought this up quite a few times. Before the pandemic, government, VA and FHA, par was low fours, probably about 4.25, 4.25, somewhere in there. Before the pandemic, conventional owner-occupied was high fours, 4.7 or so, right around there. No points or origination or anything. That's just roughly where the par rate was. And then we look at investment property, low fives, 5.1, 5.2, somewhere in there. And I closed a lot of loans before the pandemic that were right in that interest rate area, right? Low fours, and then high-ish middle fours, and then low fives. So that's where we expect rates to go back to. Now, when? We don't know. Maybe 6 months, maybe a year and a half or so. It depends. Right now, the government needs to create stability. That stability, or create not really create stability. They need to create the perception of stability, because everything is a perception for where money moves. So the government creates a perception of stability. That stability allows investors to open up their pocketbooks and invest more. That increase of cash, it's all supply and demand. So more cash means lower rates. So that's where we're really going to see rates come down, supply and demand of cash in mortgage securities. Not really anything else, but everything else kind of adds to it. So anyways, my message to realtors this week, I know this is a little bit of a longer video, but I wanted us to get onto the same page, is rates should be trending down for November and December. They did last year, they did before that. It's typically a historical trend, and it's been that way for a really long time. So we expect rates to get better November and December. If you've got buyers on the fence and they have a higher rate, check out our website, lcmloans.com/rates. You're going to see where they can search rates. Now, the rates that are offered are lower than the rates you're going to find on the search tool. I want people to see a higher rate than what they can actually get, okay? But with that being said, rates should be downward trending. Buyer's market, go out there and find some buyers, go get some money, close some deals, that type of thing. Yeah, it really is just going to be a function of lead gen and understanding rate-wise. We should be now downward trending, and we should be downward trending for a few years or so. Now, before I go, are we going to hit twos again? No. And you will never see twos again. Threes? Most likely not. Maybe tickling high threes at some point in time, barring a major financial crisis. But interest rate going down in the twos like they did, that broke so many parts of the financial industry and created so much problems. I don't see us doing that. It'd have to be a really big problem, and we'd have to unlearn the lessons we've learned in the last few years. But we'll see. I mean, who knows? Who knows what's going to actually happen? But at the same time, I doubt it. So, target, low fours, govy, high fours, conventional, low fives, investment, conventional. That's roughly where things should settle out over time. Anyways, Mike Florin, Low Cost Mortgage. Talk to you guys later. Have a great day. Go sell, sell, sell. See ya.